What's going on, everybody? Zach Macmillan back with you again for another episode of Let's Talk Mortgage. I'm laughing a little bit because I'm having to do the intro again. I did it the first time. All you can hear my daughter was crying in the background. But anyway, jumped over here real quick to talk to y'all about the difference between being approved and being eligible. Those are two completely different things, although sounding and seeming exactly the same. So we're going to touch on that a little bit today. I hope you all stick around. Let's do it. So you are going to want to put yourself in a position to get approved. Much like a receiver puts themselves in a position to catch a pass, you want to do the same thing in terms of getting yourself approved for home financing. And like I did that. So when I say that you need to put yourself in a position to get approved, I mean by making sure that you have these things lined up and prepared for yourself in regards to credit, in regards to income, in regards to money saved, having these things in line. So when it's time for you to apply for a mortgage, to get pre-qualified, pre-approved, you want to make sure that you have these things lined up and in order to be able to get approved for yourself. And just because you are eligible does not mean that you can get approved. Let me touch on that more specifically. The minimum credit requirement is 580. So let's use FHA, for example. Their guidelines state that as long as you have a 580 credit score, you can qualify for a down payment as low as 3.5% for purchasing. Now, just because you have a 580 credit score and you have 3.5% to put down for a down payment, that does not mean that you are going to get approved for FHA loan, although you are eligible based upon how much money you have in your credit score. I can't tell you how many times I've come across a situation where someone who had a 590, a 600, a 610 credit score needed more than just 3.5% to get themselves approved for an FHA loan. Now you might be telling yourself that makes no sense at all. I have my 580, I have my 3.5%, why can't I get approved for an FHA loan? Well, so what happens is you may have some other variable factors that go along with you being approved that may be adding risk or putting you in a higher risk bracket for qualifying for that loan with that low of a down payment, with that low of a credit score. It's not uncommon for you to have a 580 or a 590 credit score and still have to put down something like 5% for a down payment or 7% for a down payment, something more than just the minimum of what the guidelines say you can put down with that credit score in order to get approved. And so when I use the term put yourself in a position to get approved, I'm basically saying that if you are someone who needs to put down as little as possible for qualifying for a home mortgage, maybe you want to make sure that you have a higher credit score to offset you having not as much money to put down. Maybe you want to show a little bit more income so that way your debt to income ratios are a little bit lower and not to the maximum of qualify for a home loan. So that's the reason why I say you want to put yourself in position by offsetting some of these risks. And let's talk about risk for a second. So when we go to pre-qualify you or pre-approve you, what have you, for a home loan, what we are using are these automated underwriting system, AUSs. They are referred to as DU, Desktop Underwriter, and LP Loan Processor. These are programs, automated programs that we use, run through the system to see if we can get you approved for what loan program we're trying to use for yourself. And so in the instance of FHA, to go back to that, I'm going to structure your loan based upon the information you have given me and run it through this automated underwriting system to see if they say, yes, this person is both approved and eligible for home loan financing. Now, what happens is this AUS system, this DU or this LP, basically takes all the information we put into there, how long you stay at your place of residence, how much your rent is, how long you've been on your job, how much you make, how much you have to put down, how much you have saved, how much your rate is on the loan that we're trying to qualify you for, what's the parameters for that loan program specifically, whether or not you're actually eligible for that program. It's taking all this data and processing you and see if you are both, like I said, approved and eligible. And what happens a lot of times is you will be eligible for that loan program, but are not able to get approved because you may have some variables within your structure of your loan that is denying you essentially. What these automated underwriting systems are doing is gauging your risk assessment towards this loan program. So although you may have your 580 credit score, you may have your 3.5% to put down, it is gauging these risk assessments and saying that, hey, listen, this person is eligible, but there's a lot of risk on their DTI. The debt to income is a little bit higher for someone with this type of credit profile and a lot little of a down payment. It may be saying that, hey, listen, this is a big jump from what they are paying monthly on a rent basis up to what they're paying on a mortgage basis. There's a big $700, $800 jump, and they haven't proven that they can save money with the current rent they're paying. So why would they be able to, would it put them in a tight situation with going with a higher mortgage payment and put them at risk of default? So it's gauging all the information we put in there and gauging your risk upon getting a loan. So let's use this borrower I was working with, for example. She had a 601 credit score. She was getting money from a parent to help her purchase a home, so that was covered. However, the loan she applied for, the amount she applied for, it put her DTI still within the eligible limits, however, a little bit on the higher side in terms of qualification. So when I ran it through the system to get her approved, it was denying her because of her risk threshold it referred to, saying that her DTI was a bit higher, her debt to income was a little bit higher than what the risk threshold will quite allow. So what happened was it was requiring her to put down not just 3.5%, but requiring her to put down as much as about 10 to 15% to qualify for the mortgage program that she was looking to use to help lower her DTI within the threshold that it felt comfortable with for her qualifying. So perfect example, like I was saying, this person was eligible for a for an FHA loan program at 3.5% because she had the 580 credit score. However, to get approved, actually, she needed to put down closer to about 10 to 12% to actually qualify. Now, let me step back for a second, because I know that some of you at home thinking, well, man, that means I need to raise my credit score by 50 points. That means I need to save up at least $10,000, $15,000 more dollars. That's not quite what I'm saying. But what I am saying is that sometimes when you are weaker in one aspect of risk, you may want to strengthen yourself up in another aspect. What I mean by that is, let's say you may not have as much money to put down, but you have a good credit score and you have a well-paying job. Well, perfect. That means we may be able to get you, help you get money from a down payment assistance. You may be able to receive a gift from a family member to help cover that. And although you aren't, let's say, using your own funds to purchase, by you having a stronger credit score and a good paying income job, it would minimize risk with that higher credit score and also put you in a position where your debt to income will likely be a little bit lower in terms of your percentages. So therefore, using someone else's money in terms of down payment assistance or a gift doesn't necessarily add risk, because we have these two strong factors to help yourself, okay? Vice versa. Let's say you don't have the strongest credit score, but you have a good paying job again, your debt to income ratios are low, and then also you have a good amount of money to put down to a purchase a home. Well, guess what? Like I said, some of these programs allow you to go a little bit lower in credit score, especially if you have the funds for yourself. And so rather than you put down a minimum down, qualify at just 3.5% or 3% or 5%, what have you, you may be able to put down 10% and use that good income and that money you have in the bank with reserves to be able to qualify for that home program for yourself as well. So like I said, putting yourself in position for purchasing a home. So the overall thing in regards to getting you qualified, putting yourself in position to qualify for a mortgage is minimizing the risk that you have in terms of getting a loan. That's all we're gauging. That's all we're doing when we go to apply for your loan, to structure your loan program, we're trying to deleverage risk as much as possible so that you qualify for that $300,000, that $500,000, that $1 million, however much loan you need. We're trying to minimize the risk to show that show the underwriters and show the people that are going to approve your loan that you are not just eligible, but are worthy of approving for a loan. So be sure to do these things to prop yourself up where you are weak, so that way you put yourself in a better position to qualify for the program that you were trying to use to help yourself get a home, okay? The best thing you can do is have options when you're applying for a home. You don't want to just qualify for just one program. You want to qualify for about 3 or 4 different programs. So even in terms of being under contract, being within the process of buying a home, if one program falls through, now I have another program to fall back on to still get approved to be able to buy my home for myself. So that goes in conjunction with minimizing risk and putting yourself in the best position to buy a home for yourself. So here we go. Don't just be eligible, get approved. Do those things that's going to help you put yourself in the best position to be able to buy that home that you're looking to do. There we have it, ladies and gentlemen. Hopefully this information was helpful to you. Hopefully you have a better understanding of the difference between getting approved and being eligible, and why if you apply for a home and didn't get approved, why you may not have qualified for yourself. So this is information I want you all to take with you. Gauge where you are, understand your situation, understand where you are and potential of getting financing for yourself to be in a better position to be able to get a home the next time you apply, okay? I hope to see y'all back again right here on Let's Talk Mortgage. But we'll do this again. I'll catch y'all again next time.